Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. At the request of a subscriber to our YouTube channel, I offer this Analyze Out Loud video on Activision Blizzard Corporation. As I often do, I'm going to start this Analyze Out Loud video just by looking at the company's operating history. And there's a couple of things about this particular growth stock that I want the viewer to see here. There is a moderate amount of cyclicality to this company historically, but it is a growth stock. You can see their adjusted operating earnings growth since calendar year 2000 has averaged over 17%. Considering the average company grows about 5 to 6%, that's really an excellent number. But another thing about this that I find interesting in this particular example is they instituted their first dividend in December 31st, 2009. Now, I'm a fervent believer that in the long run, a company's stock price will follow their earnings. So let's add monthly closing stock prices here to the graph. And you can see that that statement holds water when you look at this particular company. The monthly closing stock price, the black line here, clearly went where earnings went. You can see the high correlation, and that ending in December of 2016, we suddenly have this big disconnect, probably the biggest disconnect on this chart, where the company should have theoretically, or at least in theory, should be valued at a PE of 17. Has suddenly almost doubled that to a PE of 31.3. So this shows a picture of clear overvaluation. But there's another thing I want you to see that's interesting about growth stocks that end up becoming dividend paying stocks. Had you bought this stock on December 31st, 1999, and let's just for figuring, assume you put $10,000 in it, split adjusted price was $1.28. That would have allowed you to buy 7,830, we'll call it 7 shares. Now what's really remarkable about that is even though the company did not pay a dividend for roughly the half of that time frame and started paying their first dividend in 2009, because you had bought so many shares originally, your dividend income was extraordinary. You were actually getting what some would call a yield on cost, an 11.8% yield on the original cost of the $1.28 per share. And over this time frame, you would have received over almost $16,000 in dividends. But here's the remarkable part. Your $10,000 investment would have grown to $595,000, which is a 25% compound annual return, giving you a total return, capital gain plus dividends, of almost just under 25% a year. And that correlates with the company's earnings growth, but it also is a little bit inflated, or quite a bit inflated, by the company's high valuation. But let's do some work here. Let's use the dynamic nature of FastGraphs. Let's drop this to 15 years. Now we see the earnings growth rate is about 18%. Let's drop it to 12 years, and now we're down to an earnings growth rate of 12%. And then let's drop it to 9 years, and we're back up to an earnings growth rate of 15%. And notice that the valuation reference to PE changes dramatically each time I run these different time frames. So what's happening here is the company had this high, good relationship with earnings and price, and it's got a tremendous amount of momentum since 2016, and the price has become significantly disconnected from its operating history. Even if I look at the last 15 years, which includes a couple of years of forecasting, I want you to notice, this company has just really outperformed the market. Even the dividend income was comparable to the market, but obviously the capital gain, turning 10,000 into 110,000 since December of 2005, significantly outpaced the market, roughly 5 times what the market generated. So a couple of things about this. It's a great stock. It's had tremendous performance, and it's very popular now, just as we saw with the Electronic Arts video I did a few minutes ago. Now the company's BBB+ rated. The current dividend yield is only 0.4%. And if I use dividend as a valuation reference, which I always do, even though this company has a low payout ratio, you can see here that the company only pays out about 15 to 20% of their earnings in dividends. So it still has more growth characteristics than income. But you can see the yield on this stock, the current yield is highest when the valuation is lowest. And of course now we have this very high valuation, and we've got a dividend yield that's under 1%, 0.4%. It ended the year of December 2017 at 0.5%. So this is really another indicator that the stock is fully valued. If I go down to forecasting graphs, interestingly, there are a lot of analysts that follow this stock, and they are expecting future growth to average over 17%, and that's great growth. However, if you look at what the current valuation is with a blended PE of over 31, that would imply some real serious stress on your money over the next couple of years, assuming this company reverted to the mean and went down to a 17 PE. But if we look at the way the market has historically valued the company, we can even utilize some of these real high valuations like 24 or 25 times earnings, and then all of a sudden it doesn't look so bad. But even then, if you would assume that the market would apply a high multiple to these stocks, you still have a very mooted rate of return relative to what you might earn in other investments. The point is, valuation here has gotten excessively high. Now, there are other ways to look at a stock besides operating earnings. So let's take a look at EBITDA. Now, the valuation based on EBITDA looks a lot more reasonable. It's still highly valued. If its normal EBITDA growth rate, its EBITDA growth rates average 23%, and it's normally traded at somewhere around 18 times EBITDA. So if it were to do that going forward, once again, because of the high valuation, even though there's excellent growth forecast here, your rate of return potential would be relatively low unless the stock traded at a very high multiple. If it traded at 20 multiples, that kind of thing, here we got a 21 multiple, you could make some money, but you have to be expecting this stock to continue to trade at a premium multiple for some time into the future. Now, another thing that I think is important when you're looking at these forecasts, in this particular example, the earnings scorecard is not really all that great. The 1 year forward estimate has missed 80% of the time. Let's look at the detail on that. They missed by 39% in 2013, 21% in 14, and 18% in 15. But nevertheless, if you go back to the graph up here, the company did generate really good growth with some cyclicality in the middle. Go back to, since this company does pay a dividend, let's take a look at it from an operating cash flow point of view. From an operating cash flow point of view, the company's dividend is extremely well covered, even though it doesn't yield much, so that's good. So, all in all, this is a very interesting company. It's a great stock, and it's been a great stock, but if I was an owner of this stock, I'd be a little concerned with the current valuation, and strategies might be start de-risking your portfolio by taking some of your money out of here. Take your original investment out, for example. There's different ways to play it. As I mentioned earlier in my previous article, if you look at the current performance, this stock is still showing positive performance. It definitely has momentum. So even though the valuation is high, the company does offer good momentum, but it's one that I think needs to be watched based on its current valuation. It's a really good company, has moderate debt, 31% debt, it's BBB plus rated, makes good money on its business. So let's take a look here. Let's go in and look at the company's gross and net profit margins. It generates very high gross margins in the 60% range, but the net profit margins have weakened here recently, but they can average 15 or 20% or higher when the company's performing well. There is, again, an element of cyclicality. These are the quarterly gross and net profit margins. So I would say I really like this company as a growth stock. I think it's obviously got the characteristics, even offers a little dividend yield, but I would argue that current valuation is pretty high. This has been Chuck Carnevale saying thanks for watching.